Welcome to the Big Mike Fund podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic. Starting now.
Welcome to the Big Mike Fund podcast. I'm the Big Mike.
Mike Zlotnik, and today it is my pleasure and a privilege to welcome back my really good friend, Rob Levy. Hey, Rob.
Hey, Mike. Thanks for having me. Appreciate it.
Thank you so much for coming back on a podcast. So before we start, what's new and exciting in your world? I know you do a lot of skiing in the winter. So you're still skiing? We're doing this in February, so still skiing season.
It is ski season. My family and I, we are adamant skiers. We're skiing pretty much every weekend, hoping to get 45 days a year this year skiing. We primarily go up to Vermont and love it up there.
Long drive. You got to get from northern Jersey to Vermont.
North Jersey to southern Vermont. So it's only about 3 hours, a little over 3 hours.
I guess it's not that bad.
Yeah, not bad. So we can do it pretty much every weekend, Saturday and Sunday. It's great. It's a lot of fun. My kids love it. My wife loves it. It's all good.
And it's been a real winter this year. So the few years before it was kind of mild. I don't know how skiing was, but this year it's cold.
This has been, from a snow perspective, this has been the best winter we've had in southern Vermont in about 10 years. We actually have not had any rain since December, and everything we've had, every precipitation we've had has been snow. And we have, I think, about 130 inches so far this year up in, we go to Stratton, Vermont, which is a good amount. So it's a good season so far. Knock on wood. Hopefully I'm not jinxing it.
Well, the season's almost over. So the ground did see his shadow, so we've got a little bit longer of the winter, so probably a few more good weeks of skiing. All right, back to business. So how's business? What's going on? What's new? How a lot of these open air shopping centers are doing?
So business is very good. I'll break it into two pieces. The existing portfolio and the new opportunities. As you said, Mike, and hopefully as a lot of people know that are listening, we are primarily in the open air shopping center business. We do own some multifamily as well. Just recently, we've acquired some multifamily, taking advantage of some of the movements in the market and some of the opportunities there. But for the past 8 years, we've been investing in open air shopping centers, really nationally, although our portfolio is primarily in the Southeast, Midwest, and a little bit Middle Atlantic, Northeast. And so, knock on wood, the existing portfolio is performing great. We're still seeing some really strong demand for space. We're seeing tenants aggressively wanting to expand and lease new space. And so we're seeing real opportunities. The portfolio is well occupied. We're pushing rents. We're pushing occupancy. And so that has been great. We own about 20 shopping centers today. And and the portfolio is performing great. So that's kind of one side when you ask how our business is going. That's the most important side, right? Because how are we performing in relation to underwriting what we have promised or spoken with to our LPs, and what's driving current returns on our portfolio, and that's really feels great. On the new acquisition side, it's a little bit different. Part of the challenge today is that retail has been so strong from an operational perspective that there is not that much quote unquote value add left. Most of the good retail throughout the country is either close to fully occupied or it's fully occupied. Rents have already been pushed, and because there has been some hiccups, as you well know, in the multifamily world, and there's been some challenges, certainly in office, and A lot of industrial, not all, but a lot of industrial is still priced at very aggressive cap rates. There's really only one place or one place in kind of the in kind of the key real estate sectors that investors can put their money and still get yield, and that is retail. So we're seeing an influx of capital from investors into retail, investors who were heavily into multifamily and industrial and office. And so there's a lot of capital flowing in, and at the same time, the properties are operating at very strong occupancy and rent levels. And so we're seeing values go up and yields and cap rates come down. And that's making it, more difficult to find really interesting value add transactions in retail today.
But if you were to exit some of the past deals, you probably get even a better IRR because the demand is up, the cap rates are compressed. It's kind of
Correct.
an interesting time to be a seller, probably, but finding a bargain deal is gotten tough. In the market, the capital shifted. Multifamily is disliked. Probably bigger bargains. This is where the Fort Totten. That's when you found them. It was 4 or 5 months ago. It's been a while now, 6 months. Time flies. Are you still seeing? Are you still looking for kind of multi mixed use? Because ultimately, we talked about this. High interest rate environment is supposed to be a good time to buy. And at the last Lunch and Learn, you were really one of the key folks speaking on this topic. You love high interest rates because you can actually find deals. Are you finding these deals, and where?
Yeah. So it's interesting. So we have been looking for mixed use. We have not found anything over the past few months that kind of meets the yields and the risk return, kind of requirements or opportunity that we saw in at Fort Totten. Fort Totten, as you said, really exciting deal. We closed on last summer. It's actually been, probably, well, actually, we closed in September. You're right. So it has been about 6 or 7 months, and that has been great. We're knock on wood, very excited about the kind of the ability right there, at Fort Totten, for us to um, push occupancy, push rents, and really improve operations. And so that has been so far a great transaction for us. We're trying to find more. We haven't yet, but we will. There's definitely those out there. As you said, multifamily has been struggling a bit. There's less capital chasing deals, and the combination of like big retail and multi, is a really interesting mix today. Um, just back a second to your commentary about dispositions, we agree with you, and we have actually taken advantage in 3 instances of compressed cap rates and very aggressive bidding. We took 3 deals to market over the past, call it, year or so, and all 3 executions have been excellent. So we sold a deal in Orlando at a very tight cap rate. We sold a deal in Charleston, or just north of Charleston, in Somerville, South Carolina, also at a extremely aggressive cap rate. And then we sold a deal in Nashville, Tennessee. And all 3 of those deals traded at very, very aggressive cap rates. It's interesting. The Nashville deal, we were told, it was marketed for us by CBRE. They told us that they had the most NDAs signed on any deal that they've marketed. On that deal, they had like 130 or so NDAs signed by prospective buyers. So there's, if you can present a deal in a good market with a good lineup of tenants and a little bit of opportunity for upside, there's a lot of buyers out there.
That's fascinating. That's great to hear. It's how much cap rate compression did you see as an example versus what you underwrote?
Like for example, the Orlando deal. Well, I mean, yeah, the Orlando deal. We bought at close to a 9 cap rate, and we sold it at a low to mid 6 cap rate. And same thing with Nashville. We bought that also at about a 9 cap and sold it kind of at like a mid 6 cap rate. So, fantastic cap rate compression. We obviously did not underwrite that. we underwrote our ability to improve occupancy and push rents, which we did at both assets, and then the cap rate compression was just added benefit.
So what's the forward outlook? What are the forward opportunities? What do you think you can realistically find? You brought us a deal without going to this deal. Let us keep us sort of the discussion off the table for the moment, as it's still being discussed. But it's a retail, right? You found that. So I'm just curious if you are finding more interesting retail, special circumstances, maybe not as plain vanilla. You got to find some dislocation in the market. I guess that's the search, right? Find some kind of dislocation somewhere where you see value where another person doesn't.
I think that's exactly right. I think, listen, we see every retail deal in the country, and a lot of them, most of them, will not fit what we're trying to accomplish. What we're trying to accomplish is buy good real estate, good markets, but as you said, something that's a little bit kind of off the beaten path that, for whatever reason, we can buy at a cap rate, a yield that we think is creating more yield than we anticipate. So kind of a mispriced opportunity. And to get that in today's market, you have to be willing to really dig and find assets or opportunities that are a little bit different, that have some complexity, a little bit of kind of roll up your sleeves, because a lot of the institutions won't chase those deals. They're too complicated. They'll do other things. And so, as you said, we have presented you with a deal. We're still talking about it, and it's very, it has some complexities to it. We like that. The first time we looked at that deal and some others, we liked it because it has some complexity that, we think the market mispriced. And so, there'll be those deals out there. We will find them. There's another deal in South Florida that we're investing final on. I don't know if it's going to happen. But that's another deal where there's just some complexity, a big institutional seller, and we think some opportunities. So we'll find those deals. They're out there.
Cool. In finding anything in the multi space at all? Again, Fort Totten was a mixed use, about 3/4 multi, and then super Walmart. But what are you seeing anything else? Because it feels naturally multi has really corrected. Certain some markets, especially Sunbelt, seen meaningful correction in valuations.
Yeah.
While open air shopping, I mean, it's not. It's in fact it's compressed. It's the prices are up. It's the sector is doing really well. It's at the peak of the cycle per se. While multi, most likely at the bottom of the cycle, hopefully with some initial recovery. So it's, if anything, if you want to play contrarian or be a value investor, that you got to look for that type of opportunity. Are you seeing anything interesting?
Some, it's interesting. Yes, multi is definitely reset. There's still, overhangs of too much supply coming online in some markets. You have to be really careful that you're underwriting appropriately. Some of the, Southeast, Southwest markets saw some real massive, supply growth over the past few years. And you have to be very careful that, that you're taking that into consideration in your underwriting. But you can buy at pretty attractive basis today, and decent yields. And the question is, how much do you think you can kind of push rents and push occupancy over the next 2, 3, 4 years with supply maybe still coming online? Maybe it's just about ending today. And so kind of, what kind of absorption do you think you can see? There still is a decent amount of capital in the multifamily space. We're still seeing a bunch of bidders, certainly at different, yields and at different values than a few years ago. But there's definitely, it's still a pretty liquid market. We still, because of the existence of Fannie Mae and Freddie Mac and FHA and the financing capabilities in the multifamily market, and a lot of investors' comfort in the multifamily market, you're still seeing a lot of bidders on deals, which is making it more difficult to find value.
Yeah, I heard that from multiple folks where the volume has picked up, at least bidding volume, not necessarily closing volume, but bidding volume has really picked up because there's a perception not to try to time the market, but there's enough of that that transpired, especially in value add deals. The Fed still cut, right? They still cut 100 basis points. It's a little different if you're trying to get fixed rate debt because the 10-year bond moved in the opposite direction.
Yep.
But the value add space appears to be a little bit more activity, pick up those assets.
Yeah. Well, I mean, like we just bid on a deal in Orlando as an example. We liked it a lot. It's in a good location in Orlando. It's a nice asset. It was acquired in 2021 by an investor who, in our view, overpaid a lot. And they put on, as we all know, the kind of standard story, kind of highly levered bridge debt to make it all work. And it didn't all work because the world changed over the next year or two. And so it's being offered at a significant discount to where it traded in 21, which we liked. But
how much is significant discount? What is this? 20%?
25%. But you have a decent amount of, you have a lot of deferred maintenance because the previous investor or the current owner, ran out of money as interest rates climb. So you have a lot of deferred maintenance. You have a lot of work that you have to do within the units. And there's a real question as to how much you can push rents and occupancy from current levels. And so we liked the deal and we liked the real estate and we liked the play. We just couldn't get to our returns. We just felt that you just couldn't push rents and occupancy enough. And maybe there are other investors out there that are just, okay with lower returns, right? That's, they're just, they're okay with kind of more like low double-digit returns where we're looking for something a little bit more juicy than that.
Yeah, and I do like your disciplined approach. I mean, over the years, you've at least my observation has been you stay disciplined, and that's why most of your assets have done well. So if you need to pass on something that not exactly meets your requirements, that's okay. That's not the end of the world. It's you're patient and trying to be a lot more selective. And it feels like in multi-space, there's enough product. I mean, you obviously know if you've heard of the deal we closed just now in Southeast Michigan, Waverly on the Lake, and that's a 9 cap. And of course, it's a different market. 9 cap in Orlando would be insane, but in Southeast Michigan, it's still a really high number. But it just points if you take a distressed enough owner situation, you may be able to pick up a really good asset. So let's roll forward. We're only part of 25. We go into the second half of 26, 25, and then into 26. Economy. Let's just talk a little bit about. Are you concerned about soft landing, or can we wind up in recession? Today, literally, Walmart earnings came out. Or their guidance was a little, let's just call it soft, and the market freaked out that. We're far long overdue for some kind of recession. Walmart is a non-affluent consumer. I mean, we're talking about people who live paycheck to paycheck. They are price sensitive. And I guess the market a little spooked. We finally going to see some kind of slowdown in the economy.
Yeah. I don't know. I tend to be, and I know no more than or all of your listeners know. It's just what we kind of read in the rags. I tend to be a little bit more, I wouldn't say bullish, but I feel that the Fed has done a good job of managing through the inflation and getting towards a soft landing. There's certainly some risk around it, but it does feel to me like that is the most likely scenario. I do feel that interest rates will remain elevated for a while. I don't think that's a bad thing. I think actually that's a good thing, not just for us as investors, but just for the economy. That I think interest rates have been obviously too low for too long, And I think it's healthy for the economy that interest rates are now in this kind of mid 4% range, and I think that they will stay there for a while, and it gives the Fed an opportunity to kind of reset and also give it some room when it does have to cut, that it has or kind of push down the 10-year, that there's some room to do so. So I think the economy seems like it's in a good spot. I know that there's a little bit of weakness in labor in certain spots, which is giving people pause, which is probably what you're seeing in the Walmart numbers. But I do feel like that the U.S. economy in general is in a good spot. And we'll see what happens. There's and not to get into politics, right? But there's a lot of things. There's a lot of moving pieces right now in the economic / financial world. With tariffs and cutbacks in government spending, which is, there's some real positives there. There's a lot of moving pieces, and the question is, how does that all fit together? And I think it's really hard to assess. So in our view, what we do is we're just going to kind of continue to focus on buying good real estate in good markets where we're buying it at attractive yields and where we feel confident in our ability to underwrite and manage risk, and and make sure that we're buying the best real estate, and then I think we'll be fine. But there's certainly a lot of moving pieces out there right now in the economy, which is a little disconcerting. I agree.
Yeah, the uncertainty solution. There's a book. We have a lot of uncertainty now. It's an uncomfortable feeling. A lot of business doesn't like it. The CapEx spendings doesn't necessarily take place the same level during the times of certainty. And I don't think we're going to have any certainty anytime soon. It's almost like this new administration, Trump is on a mission to do a lot of things. And the good old expression is preach a lot of change, but change one thing at a time. He's preaching a lot of change and changing a lot of things at the same time. And that carries certain risks and uncertainties. And I don't even know how we get to anything beyond, what is it called? First 100 days. Maybe at least things will clear up, at least on a bigger picture. But I too heard multiple, let's call them projections of soft landing, unemployment not really spiking much more, where we are sort of steady Eddie, with interest rates holding up. So all that is is the current base case scenario. But does it really create buying opportunity? Unclear, right? It may or may not be. And if the certainty kicked in, would it be better or worse? It's kind of you got to operate in this world of uncertainty for the foreseeable future. I don't know. Any comments on this?
Yeah, listen, one of the things I have been thinking a lot about and reading, not specifically about, but just when you read the industry rags and kind of stuff that seems like it's kind of floating to the top, I do get a little bit nervous about using an old term, stagflation. That is something that has kind of crept into my mind recently as I'm reading a lot, because I do feel that inflation could be persistent, and especially with tariffs and the potential impact of tariffs. And at the same time, I do feel like there is some risk that the labor markets weaken a bit. Not a lot, not a ton, but enough that it has an impact. And so there is, in my view, a risk of that occurring, which is dangerous, right? That's not a great place for the economy, because it's hard to beat that. You have to beat the inflation first, I think, and that means that you have to raise interest rates or keep interest rates high at the same time that you're having a weak labor market where you'd like to lower interest rates to help kind of deal with that. So that's something that I've been thinking about, and that's kind of, in my view, maybe a little bit of worst case scenario, but I think there is a risk out there about that.
Yeah, that's a very valid point. Can we see that scenario where the labor market starts weakening and the inflation is still staying hot? Although I've talked about this many times, there's a concept of the Phillips curve. So Phillips curve symbolizes the relationship between the inflation and unemployment. And you almost can't get inflation down until unemployment softens. So if you get unemployment pick up, inflation almost naturally will start coming down, sort of from that perspective. It's we can demand enough where consumer spends less of their disposable income. So it's an interesting theory. Of course, we would all like to avoid a real recession, but even if it happens, it's not necessarily the worst thing in the world because the Fed will respond. I mean, we've seen this. The tolerance for pain is super low, so probably they'll start moving rates down the moment labor market starts. The other issue, the side effect, by the way, it was an interesting conversation is why the U.S. economy hasn't really responded very well on the inflation side to the higher for longer rates. There's all kinds of interesting theories. And I'll just float a couple that, by the way, hit me. I didn't, you kind of know about this. You think about it every day, but then you don't. And that is the amount of GDP growth or investment from the AI. So I saw a webinar where the number was $16 or $17 trillion. So we had $7 trillion of COVID stimulus, and we had AI stimulus to the degree of $16 to $17 trillion. It's an insane number. And right now, it's actually creating jobs, but in the future, it's supposed to eliminate jobs for the reasons that it's automation, efficiency, etc. So that's been a boost actually to the economy. And then the other factor, completely separate, and we'll just cover on this. The higher interest rates have been slowing new supply. Housing, even open air shopping, people are just building less when the cost of money is up.
Yeah.
So it's a supply destruction, even though you're hurting the demand, but the supply is being hurt too. So I'm just curious, any thoughts on these two items, the AI impact and then the fact that the higher rates have hurt the supply?
Yeah, well, I mean, certainly we're seeing it from a supply perspective, big time, right? And it's not just higher rates, right? I mean, construction costs, inflation, construction costs are way up. We used to underwrite. It was kind of interesting. We always joke around about it. When we started buying shopping centers 8 or so years ago, we used to underwrite around $4 to $5 a foot to replace a roof. Today, it's 10 to 12 bucks a foot. So it's up like 2.5 times over the past 8 years. Which is extraordinary, and we see that in our cost to bring in a tenant. We're negotiating a new lease with a great tenant in one of our properties in Alabama, and we used to probably have you used to underwrite maybe $60-$70 a foot in costs. We are underwriting $130 a foot in cost for this tenant. And they're paying rent. They're paying more rent to get there, so it makes economic sense for us. But costs are way up. So yeah, that has been a huge impediment to supply, and that's one of the reasons why we love retail so much, because there's really been no supply in retail for the past 15 years. It's not all because of higher construction costs. That's only in the past, like since COVID, past 4 or 5 years. The first from 2009, 2010 to 2020, it was just because there was too much retail, and retail was deemed to be kind of a dying breed, and so there was no new construction. And now post-COVID, or COVID plus post-COVID, it's just because construction costs are just way too high. As far as AI goes, but I'm not smart enough to really think exactly how AI is going to impact us over the next 10, 20 years. Everything I read and it just seems logical that it is going to have a massive impact on the employment, on how we employ people in the labor markets. It can't. I don't know how it can't. I mean, and I don't want to kind of throw darts at anybody specifically, but like an accountant, like, are you going to need? I think many fewer accountants, as an example, many fewer lawyers, potentially, as an example. It's just because your ability to consolidate information and data and documents and information is going to be extraordinary. And so it has to have an impact on those markets and many others. So yeah, we have to really kind of think through how that works, and it's going to be just so significant over the next 10, 20 years.
Yeah, understood. At least the retail sector doesn't seem to be as directly impacted by AI. People still need to people still go shopping. They still want to go to a restaurant.
Yep.
So yeah, that's maybe the reason why there's been so much extra demand flowing into the space. Simply that it's a very well protected space from the supply perspective.
Yeah. Well, I
Yeah,
mean, sales have been strong. I don't think the internet has had certainly some impact on brick and mortar retail, but it certainly has not had the massive impact that some people were estimating just a few years ago. And I think people now realize and understand that we're social beings. We want to go out. We want to eat. We want to go to the gym. We want to get a haircut and use certain services. We want to be entertained. And then we want to buy our own groceries, or at least get our groceries delivered from the local supermarket, whatever it is. And so all of those concepts have continued to perform extremely well. But you have to be careful in retail, as we've always talked about, because you don't want to be in the third or fourth best retail center in a node. You want to be in the best or the second best, and that's where the demand is, where all the tenants want to be, where you can push occupancy and you can push rents.
yeah, you're right. It's a very bifurcated market. You either got it or you don't. And if you don't, people don't go there. And if you got it, you get the extra demand. And back to one comment that kind of sticks in my head. My wife is an optometrist, and I remember Warby Parker launching, pure internet platform selling frames online. And ultimately, you go and they have 600 stores now, and it's just a interesting evolution of pure e-commerce into a mix of retail. And again, the evolution is you have the e-commerce, you have the retail, you have the mobile, right? It's those three things, and now you add on top of that AI. So it's just still not clear how AI will really enhance it, but you could do a lot of, hey, go find me the best deal on I don't know, new iPhone. Where can I get it? And you can get all the information delivered to your fingertips through the AI platform, or maybe it was as simple as even some type of closing or services or something else that you can get delivered to you, and it'll influence your even shopping decisions. Could be, right? Or who's running a special on Air Jordan shoes. I don't know.
Right.
So,
Yeah, no, 100%. It's going to change how we all operate and live and shop. But at the same time, um, we have not seen a pure e-commerce company as of yet that is profitable. And the reason is because it's too
what about
expensive.
Amazon? Is Amazon not
Amazon
profitable?
is profitable because of its web services, and if you just carved out the e-commerce portion of Amazon, it's not profitable. And it makes sense, right? I mean, you've done it, right? You order something on Amazon for $2, and you get it delivered tomorrow. And there's no way that can be profitable. And then imagine, and the cost of returns. I don't know, I'm sure some of your listeners have had this experience. We have had this experience where we have tried to return things, and they've told us just to keep it because it's too expensive for them, for the e-tailer, the e-commerce company, for us to send back a product and then they have to then kind of reintegrate it into their system and try to sell it again. So They just told us to keep
Cheaper to sell,
Yeah,
especially the low-end product where the cost is low.
correct.
The overhead to deal with the return is just too high.
Right. It's just too, I said the cost around that whole system, that whole ecosystem of pure e-commerce is just too high. It doesn't work. It doesn't make sense. Where it makes sense is if you have brick and mortar locations to kind of support that. That's why Warby Parker and those are opening up brick and mortar stores because it's how they make money. It's how they service their customer. It allows for easy pickup and delivery. It allows for easier returns and stuff like that. And that's how kind of e-commerce and retail have and brick and mortar have merged, and where the e-commerce and retail companies can make money. And Walmart has done a fantastic job of this, right? Of transforming themselves into a great brick and mortar company that has fantastic e-commerce capabilities. That's an example.
Thank you, Rob, for all your wisdom. Like many other things, all good things sort of come to an end. So does this episode. Any final thoughts? Another fresh book that you read, and then how would folks wanted to reach out to learn more about LBX?
So as well, I'll answer that question first. So as far as to reach out, LBX, myself, my partner, Phil Block, our head of investor relations, Heath Binder, you can find all of our information on our website, lbxinvestments.com. So please reach out to us if you have any questions. You want to ask us anything about our current portfolio or opportunities going forward. We're happy to discuss. As far as final thoughts go, I don't know. I think we've kind of said a lot. I think I think the next year or two are going to be really interesting. I think it's going to be a little choppy waters, which from my perspective is a positive. I think that's where really good operators with the right relationships and platforms can create value, and I think we're one of them. So looking forward to it, and Mike, looking forward to continue to invest with you and your team and doing some good deals together.
Thank you, Rob, for your wisdom. Thank you for sharing, and enjoy your skiing.
Thank you.
Well, the season is still cold. Do a couple more trips. Enjoy it before the weather gets warmer.
Thank you.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.